Hello, friends. I'm Amir Reza Abdollahi. Today, I want to talk to you about a topic that might seem dry and complex at first, but in reality, it directly affects all of our pockets, whether we live in the United States or anywhere else in the world. Yes, trade tariffs, inflation, the role of the Federal Reserve, and the massive US government debt. At first glance, you might think these are just technical macroeconomic topics, but believe me, every decision made here can directly impact on price of food, housing, energy, and even the future of the financial markets. Let's break it all down step by step. An old tool with new effects. The United States has long used tariffs as a policy tool. A tariff is a tax imposed on imported goods. The idea behind it is simple. When imports become more expensive, domestic production becomes more competitive. On the surface, it looks good, right? Supporting American workers, supporting domestic industry. But the problem starts with US economy is heavily reliant on imports from raw materials to everyday consumer goods. When imports get more expensive, costs go up and that means inflation. Inflation and pressure on people. According to report by Goldman Sachs, the bank of Goldman Sachs, the direct effect of tariffs is price increases. Imagine a family that has to buy groceries, clothes, household items, or even car parts every day. When these goods get more expensive because of tariffs, the direct pressure falls on the consumer. And the more important point, this pressure hits the middle and lower classes much harder because a larger portion of their income goes to these daily expenses. So, contrary to the slogan, supporting the people, the result ends up being the opposite. The role of the Federal Reserve. Now, here comes the Federal Reserve. The Fed is responsible for controlling inflation. When inflation rises, the Fed's main option is to raise interest rates or at least not lower them. Raising interest rates means what? It means mortgages become more expensive, student loans become more expensive, business loans also become more expensive. This means investment costs for companies increase and economy growth slows down. So a single decision about tariffs can trigger a domino effect. First, inflation rises. Then the Fed reacts. Then businesses and households feel the pressure. United States national debt, a ticking time bomb. Now let's get to one of the most dangerous topics. US national debt. US debt has now surpassed $34 trillion. Many economists call it a ticking time bomb because the spending continues to rise and government's revenue is insufficient. A serious financial crisis could emerge. Tariffs can temporarily bring revenue to the government because ultimately the tariff money goes directly to the treasury. But the on, but on the other hand, if economic growth slows and inflation rises, the budget deficit increases and the government has to borrow again. So it's the same recurring story, borrowing more to cover more expenses. And Global effects when the US sneezes. What is this? There is an old saying in economics: when the United States sneezes, the world catches a cold. US tariffs don't only affect itself. China, as the largest exporter to US, takes direct hit. The European Union faces reduced exports. Emerging markets which rely on global supply chains feel the most pressure. Tariffs can disrupt supply chain, meaning components coming from East Asia, a product manufactured in South America, or a good assembled in Europe. All of them become more expensive and slower to reach consumers. This means global inflation, labor market, and wage. Now, an important question is, are tariffs really beneficial for American workers or not? In the short term, some domestic industries like steel or auto manufacturing may suffer less from foreign competition. But over time, rising costs make it difficult for even these companies to remain competitive. On the other hand, if inflation persists and the Fed keeps interest rates high, the likelihood of a recession rises. And recession means a lower demand for labor, meaning the very worker who was supposed to be supported is at risk of losing their job. Investing and economic future. When uncertainty when uncertainty in the economy is high, like with these tariffs and trade tensions, investors pull back. Foreign investment decreases, companies halt new projects, and economic growth suffers. Now the story is no longer just about the US global investors. When they see the US economy becoming risky, move their capital to safer markets like US Treasury bonds, like gold. So, friends, we see that discussion around tariffs is not just a political tool or election slogan. This topic is directly tied to inflation, Federal Reserve policies, its government debt, labor market, investment, and the global economy. On the surface, it may seem that these policies are designed to support domestic production, but in practice, they can put significant pressure on people and the entire financial system. At the ending, now it's your turn. Do you think tariffs truly benefit the United States economy, or are they just a temporary fix that, in the long run, creates more pain? Share your thoughts in the comment below, because this discussion doesn't just affect the US economy, it influences the future of global market as well.